Welcome to the Foundation Series, your deep dive into startup compensation with industry leaders from across the startup world. Join me, Matt McFarlane, a people operations leader turned compensation specialist, as we uncover the strategies and practices driving success in tech startups around the world. Hear insights from heads of people, founders, and experts as we explore how to build robust compensation frameworks that not only fuel growth and retention, but do so in the dynamic startup environment that we all know and love. Let's get into it. Andrew, great to have you on the podcast. I feel like I say this of all of my guests, but it's because I genuinely invite people on here that I have followed for some time and really respect in the space, and I think are just doing really fascinating and interesting things, but none more so than yourself. So I won't dive into the reasons why I think I'm so excited to have you on the podcast, but I'd love you to just spend a minute introducing yourself for those who maybe aren't as familiar with you as I am.
Well, thank you. Really appreciate being on your program. Thanks for asking me. Great to connect this way. I'm an HR guy. I've been doing this work for 30 years, in-house, the vast majority of that at giant enterprise companies like Pepsi and GE, where I learned how to do HR, air quote, right. I had a startup experience really early in my life and career during the dot-com boom and bust. And so, took a company global and then took it out of business. And had a lot of stops along the way, really culminating with a CHRO job at what is now an S&P 500 company that I helped take public twice through a bunch of M&A and PE sponsor entries and exits. And I pulled my parachute back in 2018 when headquarters moved from California to Arizona to Dallas, Texas. And then that let me, a little bit of flexibility as all my equity vested, and got a silver parachute, and wrote a book and started consulting and advising. And now I'm doing all sorts of work, which is mostly facing other HR professionals. So really, I think of the work that I do now as growing CHROs in a number of different ways.
I love it. Thank you for spending it. I think you did a really good job of just capturing the breadth of expertise. And I think that's why I've really, so thoroughly enjoyed following you on LinkedIn and in some of the other ways that you've published some of your knowledge, is it really does span like early to late to, taking companies public to doing all of these different things. So I'm excited to dive into a few of those topics with our sessions today. The first one I want to touch on is this concept of like how ownership is used differently in a PE, so a private equity environment. Now, when we started talking about things to talk about, like I was really intrigued by this because I'm the first to put my hand up and say I've got zero experience in the PE space. So maybe let's start with, just the background. Like tell us a bit about what it is, how private equity works and how this sort of ownership incentivization structure differs and why.
Sure. Well, private equity, I think not a lot of people really do know how it works. I had worked at a number of different organizations that had been PE backed, and even then it was kind of a mystery to me. So many years into the career, and now I'm a operating partner and senior advisor for the past 5 years, with a really wonderful group of investors that I won't mention the name, don't need to, call out exactly what firm. You can look it up on my LinkedIn profile, but they really know what they're doing. And I think here, I'll give a little bit of a primer. PE is private investors in private companies. And so a limited partner, an LP, an investor in a PE fund might be a pension fund, like the California school teachers. Or it might be a university endowment, like Harvard or Columbia have, a massive endowment from donors. Or it might be a sovereign wealth fund. Middle East is investing a lot of oil proceeds into U.S.-based private equity. It could also be wealthy individuals, but largely private equity is backed by those are the big LP sources. Um, and largely it is investing in private companies. And that means you might make your money taking them public. You might make your money growing them. You might make your money fixing them. But generally, the idea is that it's a good risk reward trade off. A higher rate of return than you would get through the public markets, or than you might get in a regular stock fund, or money market in the bank. So there's this whole part of the economy that is based around building and growing and fixing private companies. And it's fascinating. I continue to learn something every day. And I don't know. I guess I'll just pause there and take a breath and like figure out like, okay, what part of this do we want to peel back?
Well, I mean, for me, like the things that jump out at me and when you just give that background is like there's such different interests, I'd imagine, that accompany such a diversity of private investment. Maybe before we dive into the ownership structures and how that sort of manifests in that sense, like how does this change things for a head of people? Like how do they tend to, see this show up in their day to day?
Yeah. Well, I think you nailed it, Matt, by calling out the incentives and the stakeholders. I think any head of people is really well served by understanding who are the stakeholders, who are the people who have controlling interest in our organization, and what are they trying to accomplish. The employees matter, leadership matters, so do investors, and understand who your investors are and what they're trying to do. So in the public markets, you have a highly liquid investment in that you can buy and sell stock every day on an open exchange. You can day trade it. In the private markets, it's much less liquid. So you're looking for a transaction, right? The holy grail for a startup tech company is going public, or it used to be. IPO window is maybe cracking open a little bit. Chime just announced a couple days ago. I guess I'm dating the episode now. But in private companies, what you're really looking for is either an IPO event, which is rare and only really available to companies of a certain size, or a transaction, that exit where the investors get their money back and hopefully a lot more. And that would usually be, in a lot of cases, a sale to either a strategic, which would be a big company that does what your company does and it absorbs it. And there could be a number of good reasons for that. Or it would be another sponsor. So another investor, maybe a bigger, later stage private equity company, would put money in and grow it, to the next plateau. And so understanding what those time horizons are and what those goalposts are helps a leadership team, including a head of people. But it's really helpful for the CEO, the CFO, like everybody on the leadership team to understand what is that finish line that we're running towards. That helps you make choices with capital and management practices, and it gives you a time horizon.
Yeah, and does the roadmap you have in mind kind of fit within that? Is it innate of that? All of those sorts of things come to mind. I think, like for me, whenever I think of PE, and this absolutely comes from my lack of experience with them, I think there's probably a real myth there that you have to correct, and I'd love you to correct it in this as well. Of private equity comes in, they cut a lot of cost, they say goodbye to jobs, and then they float it and sell it. And I think that might be one scenario. I'm sure that happens, but as we sort of segue into how we incentivize through ownership, how does that tend to differ between that myth and reality?
Yeah, I feel like PE needs PR. Private equity needs some public relations, like in general. Maybe that's a tagline that we grab at some point. My first exposure to PE was from the movie Wall Street, where the Sheen family, or yeah, I think it was Emilio Estevez, was convincing a capital sponsor to buy the airline company that his dad worked at, and then they laid a ton of people off, and it was a story of greed. I remember the Michael J. Fox movie Secret of My Success, where there was another PE company with a transportation company where they were slashing jobs, and the movie Office Space as well. It's always the big bad guy with deep pockets that's laying off the workers. And in reality, I haven't seen that. I've worked with a number of different PE firms. I've been a part of a number of companies that were PE owned. The idea of investment is that you get more back than you put in. And this is a massive generalization. You generally get there by growing, not by cutting. So, when the firms that I work with, they're usually trying to figure out how to 4x their investment. And you don't just get there by hiring AI agents and laying off your call center or automating a ton of stuff and letting people go. You don't get there by cutting. You get there by growing, by consolidating, by adding more organizations to your platform, by offering new products, new services, by doing it better, by extending into e-commerce, what used to be a physical product only, or offered through distributors, now direct to consumer. You get there by growing, and so that's largely my experience, and that means you need to invest in people, you need to invest in technology, you need to invest in often more professional ways of doing things than a lot
Yeah.
of founder-led or family-led organizations that got them to a certain degree of success.
Yeah, okay. I'm glad we're setting the record straight. So if I'm hearing correctly, it's really about like they're obviously seeing an untapped value in this business. They're going, okay, we've got a set of expertise, people like yourself who have been through this process before. We can come in and sure, there may be some optimization, but actually it's like what are some ways in which we can see value that the business hasn't kind of capitalized on itself, and it's how can we unlock that with our expertise, which is good. I think that's. I'm glad to hear that that's a more common scenario that you've had experience to. Let's segue a little bit into this concept of profit interest. So again, this is my naivety around private equity. Let's just start with like, what is it? How does it differ from maybe the more commonly known stock options or RSU terms that people certainly potentially listening to this show are more familiar with? What is it? How does it work?
Sure. So, yeah, I have experience in all three of these environments, from publicly traded companies with mostly RSUs, restricted stock units, restricted share units, startups, mostly tech with stock options, and then profits interests. Okay, so with RSUs, you actually own a piece of the company. Um, Again, I'm generalizing, but I'll try to keep it simple. It's like owning a share that you need that has a vesting period and is tradable after a certain amount of time. With options, as many of us know, if you have tech and startup listeners, and I'm guessing you have a lot of those, people are relatively familiar with that, where it's actually not worth anything until there's some sort of liquidity opportunity, which is a sale or an IPO. And so stock options could be, just totally untradeable for a really long time. And, some companies are doing secondary offerings, et cetera. So stock options are the option to purchase the stock at some point in time in the future at a pre-agreed upon price. A profits interests is a little bit like a stock option in that it's not worth anything today, and it's only worth something at the time of a transaction. So maybe that's an IPO, an initial public offering. More often, that's at the time of a sale. So profits interest would be, let's keep it simple. You bought a business for $100 million, and then you sell it 5 years later for $200 million. You might think that the difference there is 100, 100 million versus 200 million, but there's a variation there in terms of, well, how much leverage was on the business, meaning they probably didn't buy the business for 100% cash. When you're buying a business, you're usually getting bank loans, you're getting other investors to get involved, and so you have to pay off the capital first. And so out of the 100 million that the business was bought for, maybe 40 million of that was cash and 60 million of that was borrowed. And so then when you sell it for 200 million, you actually have a bigger profit. You put in 40 million cash and you get out 200 million. So that's a massive return. So that is part of what, leverage is part of what creates some real upside opportunity. But it also creates some risk for organizations that then need to service that debt. So just like a home mortgage, the banks are going to charge you interest on that, and it's going to be a lot higher for buying a business than it will be to buy a house. And so the profits interests are a percentage of the profit upon the sale of the business. That's probably the simplest way I can put it. And there's a lot more math behind it, and there are a lot more assumptions and variables.
Naturally, yeah.
But that's the top line.
Yeah. Okay. And so if I try to draw some parallels between this kind of this profits interests concept and maybe options, which again are probably a more familiar one, options have these like preferences that come with them, and that tends to kind of create an order of how in which any sale or whatever might be paid out as well. I guess it sounds like that's probably a similar concept then in the sense to this leverage piece.
That's right. Yeah,
profits interest.
You can certainly have different classes of stock or different payment sequencing and preference. Yeah. And that's where it can get really complicated. There could be something where the investor gets their money back first and then the profits come off the top, or maybe there's an allocation that covers some of the deal fees, because just like you don't buy and sell a house without a realtor who takes their cut, and without a title agency who takes their cut, and an appraiser who takes theirs. Same thing in business, but the numbers all tend to be a lot larger. So deal fees are meaningful. And then the debt service, we talked about, the banks are loaning you money on the purchase of that business, and it could come at 10% or more, 12%. That it's not crazy in today's world for double-digit interest rates. So there certainly could be some escalators and some thresholds that get thrown in there, but generally, trying to keep it top line, it would be, what is the profit of the transaction on the sale of the business? And you only get that if and when the business transacts. And one of the more complicated things to wrap our minds around is you don't really know the value of it until it's sold. So it's not publicly tradable like a General Mills or a General Motors or a General Electric. I guess I'm thinking generally. So you can't see the valuation on any given day. It's, usually you'll use some sort of business broker or investment bankers to, shop the business. You could get dozens of interested buyers, and then you go through a letter of intent process and indication of interest. You go through a lengthy due diligence process. And so you just don't really know what it's worth. I know in the startup world, we do our 409A valuations, and let's be honest, that's very flexible. That could move massively. So that's how profits interests work. And maybe a few points that would be relevant for the audience. What I've seen is typically a management team, like a senior management team, C-suite level SVP types, would receive 10 to 15% of the profits interests. So that's intended to incent management and align interests to get the greatest value for the business at the time of transaction. Of course, the CEO usually gets the biggest chunk of that, and the rest gets spread out in a usually unequal way. And so actually that's a live conversation. I was just trading emails with some members of the People Tech Partners community today and yesterday as some questions were bubbling around PE profits interests. So there's usually this allocation, and then that gets re-upped or refreshed at the time of a transaction. So a strategic comes in and acquires the company, or a new capital sponsor. The management team gets paid out in cash, usually, and then the new sponsor wants to try to lock them in, put the golden handcuffs on to take them for the next 5+ year ride.
Yeah, interesting. This is such a. So, firstly, I don't want to let it go unsaid. Thank you for what might be the first dad joke on this entire series, with your generally one. But this has been such a a great 101 on profit interest. What, as a sort of a closing moment for this episode, what would be one thing heads of people need to consider when it comes to how something like this is applied to people?
For a head of people, I would say realizing the profit interests are maximally flexible. You can do basically anything you want in terms of program design. You can offer profits interests to every employee if you want to. One of the firms that I work most closely with is a member of a group called Ownership Works, which is a nonprofit that spun out of KKR, one of the granddaddies of private equity. And they started this concept of broad-based employee ownership. Well, they didn't start it, but they broadened it in PE for sure. And so the idea is, even if you are working third shift warehouse in Louisiana, you can and you should benefit from the upside at the time of a transaction. And you have a stake in the company. Boy, a million years ago, I worked at Pepsi, and we issued stock options to everybody, including the unionized route drivers. And some people got it, a lot of people didn't. Communication was really required, lots of education. So there's some complexity to it, but there's lots of upside. And so I guess I'm taking the long way around the yard by saying profits interests can be constructed just about any way you want, whether really targeted and really focused to your highest need contributors. Highest need meaning the people that you need to get the value creation plan, or broad based. You can set whatever sort of vesting thresholds you want. You can set any sort of earnout tiers that you might need, and so it allows for a tremendous amount of creativity and flexibility. So as a private company, you can do some pretty interesting things with profits interests.
Yeah. And KKR, the name is familiar with me because, and I can't remember the company that was the example, but there was a really great case study around the value it created for all employees upon the sale of it. And I think it goes without saying that, like most ownership incentivization structures, you really do have to communicate regularly and often. But I think also, if you're going to give people the sense that they are a part owner, then they have to be able to have a voice like an owner in some respects as well, and be able to have a means and a channel through which they can convey feedback or direction in some sense as well. So it really does become a big thing. But super interesting to hear about how flexible it can be and how it can be leveraged really creatively. Thank you. Thanks for running us through it. We'll draw that one to a close.
All right, sounds good.
Thanks for joining us on another edition of the Foundation Series. Make sure to head over to our website to subscribe to the Foundation Series for monthly editions featuring future interviews on startup compensation. In each edition, we'll explore the different strategies, trends, and challenges faced by startups around the world. If you have a burning topic you'd like me to cover or a standout guest that you want to hear from, drop me an email so I can dive deeper into the compensation topics that matter most to you. Join me next time as we continue to uncover the strategies and practices driving success in global tech startups around the world. Thanks for listening.